So welcome to this video. In this video, we are going to discuss about cost of capital. So we'll discuss about first what is cost of capital. See, the equity shareholders of a company are expecting the dividend from the company, or they expect the share price appreciation. So that's what they expect. The debenture holders or debt holders expect the interest and the safe principal repayment of their money. Thus, the cost of capital is the rate of return that the enterprise must pay to satisfy the providers of funds, and it reflects the riskiness of providing funds. So, assume that the company raises equity or debt. Both the equity holders and debenture holders expect some kind of additional monetary return from the company. The company has to pay it. Okay, so that refers to the cost of capital. The capital which they provide comes at a cost. Okay, that cost can be dividend, share price appreciation, interest, and safe repayment of principal. It is therefore the minimum return that a company should make on its own to earn the cash flows out of which the investors can be paid their return. So as they pay, as the equity shareholder and debenture shareholder are giving capital, the company has to minimum earn at least the money that has to be paid to them. Anything which the company earns more than the cost of capital is what the company can retain. So we look at the creditors payable hierarchy so that we can find out like who is taking more risk and who is taking less risk in providing capital to the company. So this is the order. Uh, the creditors with a fixed charge have the lowest risk, because what is a fixed charge? Fixed charge means any creditor who has given money to the company, but he is securing his loan on a particular machine or on a particular car or on a particular vehicle. If the company is not going to pay the repayment of the capital, then the creditor will take hold of that particular machine or car or a vehicle. So that is called as a fixed charge. What is a floating charge is? Floating charge is a general promise that the creditors can take any asset of the company. So the creditor is sure about that he will get any asset of the company, but he is not sure which asset he will get. So there is some kind of a uncertainty in the coverage of the asset. So that's called as floating charge. Unsecured creditors, these guys don't have any promise. Then comes preference shareholders. Then lastly come the equity shareholders. Okay, so assume a company gets bankrupt. This is how they get paid. So the person who has the least risk is creditors with a fixed charge, and the person who takes the highest amount of risk is the equity shareholders. So the creditor hierarchy refers to the order in which financial claims against a company are settled when the company is liquidated or bankrupted. The risk of not receiving any cash in liquidation increases as priority decreases. So equity shareholders get the least amount of assets at bankruptcy. The return required by a provider of finance is related to the risk faced by that provider of finance. So as equity shareholders take the highest amount of risk in a company, they also require a highest amount of return. Secured creditors therefore have the lowest rate of return, and ordinary shareholders have the highest required rate of return. So this is how the rate of return or the return from the company is set. The cost of debt is less than the cost of preference share, which should be less than the cost of equity. So we can write it like this: KE, which refers to the cost of equity, is higher than KP, the cost of preference share, but KP is higher than the KD, cost of debt. Okay, because equity takes the highest amount of risk, uh, preference shareholders take the lowest amount of risk, and still small level of risk is taken by the KD. So this is how the risk and return are related. So we'll look at a quiz. This question was asked in September 16 of ACC exam. The loan notes are secured on non-current asset of Parco, and the bank loan is secured by a floating charge on the current assets of the company. In terms of risk to the investor, what are the riskiest and the least risky source of finance for Parco. Okay, so which one is the riskiest? They're asking. See, the riskiest by nature is the equity shareholders. So answer B and D can be the answer. Which one is the least risky? Okay, the loan notes are secured on non-current asset. So, and the bank loan is secured on floating charge. Usually floating charge is a higher risk, but on a particular non-current asset is a lower risk. So the lowest risk is the loan notes. So this is not the answer. This should be the answers. So we have two ticks marks in ordinary shares and loan notes. So the answer should be D. Okay, that's how the answer is arrived. So we look at the different cost of capital in a company. So we have KE, cost of equity share, KD, cost of debt, and KP, cost of preference share. So why is KE higher than the KD? Why is the equity investors want more return than the um, debt holders? Equity shareholders are paid dividends only when there's money left after paying other financial stakeholders. So the risk is higher for equity holders. At the time of bankruptcy also, equity shareholders are paid as the last person. After paying all the people only, equity shareholders are paid. So again, they take a risk. Hence, equity shareholders take more risk. Hence, they require a more return. And that is why we have the concept of KE is higher than KD. This is a very important question. So ensure that you understand this concept really well. So there's something called as a reverse yield gap. So just now we saw that KE will be higher than KD. Okay. So sometimes KD can be higher than KE. Okay. So we look at those instances. Sometimes KE will be lower than KD. Why is that? See, we look at this table. So the first table here tells you about the Indian government's bond. So this is the interest rate. These are the interest rate. Okay, and this is a company called as a Navy Lignite Corporation, and this is called as a dividend yield. Okay, dividend yield refers to the return that the investor will get through dividends. Okay, so if you invest in the government bond, it's 6.65. If you invest in the shares, you will get 2.8 as dividend yield. Okay, so how come this can be contradictory? Normally this is the right one. Okay, KE should be higher, but it's only 2.8 here, and the KD seems to be 6.65, which is higher. Okay, the answer is a reverse yield gap occurs because shareholders may be willing to accept lower returns on their investment in the short term in anticipation that they will make future capital gains in the future. Okay, so the concept works like this. The dividend yield can be like 2.8. Okay, so what equity shareholders want, if you take the KE, they want two things here. One is the dividend and two is capital appreciation. We only looked at the dividend part of it and we left the capital appreciation part. That's why reverse yield occurs. Okay, reverse yield gap occurs. Okay, so we should take two things into account, the dividend and also the capital appreciation, right? So take two things into account, then you will get an idea that the equity shareholder wants dividend and capital appreciation. So what are the various methods for computing the cost of capital? So we look at the various methods. To compute KE, we have these methods. We have number one, dividend valuation method without growth and with growth. Then we have the CAPM model. In cost of debt, we have irredeemable debt, redeemable, convertible, and non-tradable debt. In cost of preference shares, we have irredeemable preference shares. Okay, so in an exam, what will happen is the question is set in such a way that you will get a question from a 10-mark question from all of these methods. Okay, so you will be having in a particular question this method, this method, this method. That will be one part of a question. Or in some other exams, you might have KE found out through CAPM, convertible debt, and preference shares. Okay, so it depends upon the question. The logic is you should be like able to work out all the methods, and that is how the final question is tested. Okay, so ensure that you know all the methods in the cost of capital, so that whatever method they ask in the exam, you will be like comfortable in solving them. So we'll start from one of the methods. It's called as dividend growth model. It's for finding out the KE. According to the model, the cost of equity is a function of the current market price and the future expected dividend of the company. So what does the equity investor want? He wants dividend. So we based upon the dividend, we try to find out the KE. Okay. So D0 plus 1G, solve this and add the final G. You will get the answer. We'll work out these problems later. So we'll look at the theory here. The DVM model states, these are the assumptions. Okay, these are the assumptions. Future income stream is the dividends paid out by the company. So the income of the company is captured in the D0 or dividend. So that's a assumption. Dividends will be paid in perpetuity. That is, the company is always going to pay dividend. Dividend will be constant or growing at a fixed rate. So all these three assumptions should be applicable. Only if it is applicable for a company, you can use this method to value to find out the cost of capital. So what is the weakness of the model? First one, this model does not take risk itself into account. 2, capital gains is not all taken into account, only the dividend part is taken into account. 3, taxation is also not taken into account. 4, there are different types of price. Okay, so the model works like this: D1 plus G divided by P. The price, the P refers to the equity share price. There are different prices for the same share in the market. For example, 52-week high, 52-week low, average price for the year. So which number we should take? That is a question mark. Dividends actually do not grow smoothly in reality. So the G that we take here, okay, the growth rate in dividends that we take here is an assumption. The model does not produce meaningful result if no dividends is paid. So assume that D0 itself is 0, is just 0. So the answer is 0. Okay. So this model cannot be working in all the places. This model has several weaknesses, and this might be asked as a theory question as a part of a 10 mark or a 20 mark question. So you should be able to know the weakness of this model exactly. The weakness of the model can be memorized in terms of these things. D is a drawback. Okay. G is a kind of a drawback. The P is a kind of a drawback. There's no tax. There is no taxation. There's no capital gain. There's no risk. Then you have P is a problem. D is a problem. Also G is a problem. Okay. So you can easily crunch these weaknesses much more better. So now we look at the weighted average cost of capital. We have found that each source of funding, for example, equity or debt or preference share, has their own cost of capital. So we found out that there is a KE, KD, and KP. But what is a weighted average cost of capital? A company, in order to finance itself, it usually gets finance in all the manners. For example, a company might get equity capital, debenture capital, preference share capital. So all these capitals gets mixed, and from this common pool of money, the money is taken and invested in a project. So how will you discount? What kind of discount factor will you use for the investment in a project? Okay. So the question is, we can't find out a particular KE or KD or KP for a particular project. Better we'll use a WACC. So WACC works like this: KD, KE, KP, all these things get mixed, okay, and they become a pool of funds. Okay, this pool of funds is used to invest in projects. Okay, if this pool of money is invested in projects, then if it's used in projects, then the WACC is the appropriate rate at which the projects should be discounted. So the WACC is the discount factor. We don't use the KE, KD, KE, KP as a discount factor. We use the WACC as a discount factor. So how does WACC works? So assume that a company has two kinds of capitals. It has taken a debt capital and it has taken an equity capital. The debt capital, the company pays 6%. there's a tax benefit, so they get 4.2 is the effective interest rate for the company. The company also pays as a dividend or capital appreciation of 15%. So cost of equity or KE is 15. So what happens is this company uses only 25% of their total capital as debt, okay, and 75% of the capital is equity, okay. So what happens is this 4.2 gets multiplied by the 25% capital, it becomes 1.05. The 15% gets multiplied by the 75% and it becomes 11.25. Add both of these, you will get the WACC. You will get the WACC. The WACC is 12.3. This 12.3 is becomes the discount factor, which is used in a variety of places like NPV, and finally we accept or reject project. We accept a project or we reject a project. Okay. So see how important the WACC is. If you get the WACC wrong, your discount factor is wrong, your NPV is wrong, you will reject acceptable projects, you will accept rejectable projects. Any kind of problems can occur. So getting the WACC is a crucial thing for a company. So we'll have a quiz now. What is WACC? Is it a rate of return on assets that covers the costs associated with the funds employed? I think this is the answer. The minimum rate a firm must earn on high risk projects. No, it's not about the high risk projects. This is wrong. The cost of the firm's equity capital at which the market value of the firm will remain unchanged. It's meaningless. The maximum rate of return on assets. This is also seems to be meaningless. So A should be the answer. Perfect. Again have a question. This question was asked in December 2014. Which of the following statements are correct? Investors faced with increased risk will expect increased return as compensation. Yes, this is correct. An increase in the cost of equity leads to a fall in share price. This is also correct. The cost of debt is usually lower than the cost of preferred shares. This is absolutely correct. So the answer should be D. Yes. Okay. So you might ask a question why this seems to be true. To discuss this, we have to look at the chapter called as capital structure. So you can now you can assume that this is to be true, but the reason for this we will discuss in capital structure chapter. Well, we come to one of the most important areas in the chapter. Okay, this can also come as a theory question. WACC can be computed in two ways. One is book value weights and the other one is market value weights. So first we'll look at example, then we'll go to the discussion part. So we'll assume a company has two types of source of funds. One is equity and the other one is debt. Okay, book value refers to the balance sheet value. Book value refers to the balance sheet value. Okay, so there is 10 and there's another 10 here. So the total capital comes to 20. The proportion of the capital is 0.5 and 0.5. So 10 divided by 20, it comes to 0.5. The cost of capital, we will take it as equity is 20 and debt is 10. So proportionately, the cost of capital is 10 and 5. So the WACC comes to 15. Okay. So this is the book value method. So assume that we will use the market value method. So the market value method works like this. The equity which was issued a few years ago was at 10 million, but its today's value stands at 100 million. So the share price has risen and it has become 100 million. The debt was issued some 5 years ago and now its price has moved to 11 million. Okay, so the total capital now stands at 111. If we proportionately work out, it comes to 0.9 and 0.1, that is like 90% and 10%. The cost of capital remains the same. Whatever number we used, the same number we use it here also. So the proportionate cost of capital comes to 18 and 1. The WACC comes to 19. Okay, so the concept works like this. If we take the book value method, it always shows you a lesser amount of WACC, okay, than the market value method. The reason is the equity is always lower. Okay, the equity is always lower in the book value method. It's always lower in the book value method. It's actually not lower, it is understated than the reality. That is the problem. So what happens here is we might select projects which are useless for the company, right? We might select project that has to be rejected. So this is the problem. Okay, so at 19% we would have definitely rejected a project, but if you do use a wrong number such as 15% as a discount factor, we might select that project. So we'll move on to the next slide. So here we'll discuss certain things. Market values of financial securities reflect correct market conditions and current required rate of return. So the market values are always perfect. The market values therefore always should be used in calculating the WACC. The market value of equity is usually greater than the book value. So using the book value weights would seriously underestimate the relative importance of the cost of equity in WACC. Okay, so you should always use market value weights as far as possible. If numerical questions indicates you to use the best method, then for computing WACC, then compute WACC using the market weight. If the numerical question does not indicate which method to use for WACC, then check question information to calculate the appropriate one. Okay, so if the question is like open-ended and says compute the best method, compute the market value weight. If the question does not state which method to compute, then try to compute market value weight. But if the data is not available, then you have to compute the book value weight. Okay, so the question is, that's how they are designing it. If book value are used as weights, the WACC will be lower due to the understatement of the contribution of cost of equity, which is higher than the cost of capital of other sources of fund. KE will be shown as a lower amount. If book value WACC were used as the discount factor in investment appraisal, investment projects would be accepted that should have been rejected if market value weight were used. This is a very important point from exam perspective, so ensure that you understand this. Using book value WACC as the discount factor will therefore lead to suboptimal results and investment decisions. When WACC can be used as a discount factor? So can you use WACC as a discount factor in all circumstances? The answer is no. Again, this is another theory question that is like repeatedly being asked, and it's very important. The WACC reflects the current risk of company's business operations, okay, and the way in which the company currently is financed. Okay, so WACC reflects your current business and your current financing structure. So that is what WACC is all about. So if you want to use WACC as a discount factor in investment appraisal, then these three things should have been achieved. Number one, the project for which you are using WACC as a discount factor should be a small project relative to the company. If it's too big, you should not use WACC. The existing capital structure will be maintained. So your debit equity structure is not going to be changed. Only then you can use WACC. The project has the same business risk as compared to the company. If the company is already into supermarket business, then the project is also into supermarket, means then you can use the WACC. If the company is into supermarket and it wants to enter into construction, in that case you cannot use WACC. Okay, so these three things should be ensured, then only we can use WACC. So what are the arguments against WACC? So again, the same arguments are here. WACC can be used only when the business risk is same and when the financial risk is the same. So the company should be in the supermarket business and the project should also be in supermarket business. The company should be having the same debit equity structure and the same capital should be used for the project. Okay, the debt equity structure should not change. Okay, so that's about the arguments against WACC. So we'll look at this part of the question. Again, this is a very important part from an exam perspective. When WACC cannot be used as a discount factor. So these are the situations. WACC can be used as a discount factor when business risk is same as existing, finance risk is same as existing. That is, we are going to use the same debit equity ratio. Okay. So in business risk, the same supermarket to supermarket. Okay. In marginal cost of capital, the business risk is same. The same supermarket is entering into supermarket business, but the debit equity structure is going to be different. In that case, you have to use marginal cost of capital. There's something called as a gearing and re-gearing. Okay. Gearing and re-gearing is used when the supermarket business is trying to enter into a construction business. Then you can use rearing and gearing, but the debt equity ratio of the company is going to remain the same. Okay, so we have different types of models. In each model, you should be like very careful which is like has to be used. Okay, in ACCA exam, you have theory and the problem for this, and it's very important. Marginal cost of capital is only theory. Regearing and regearing is both theory and problem, and it's also like very important. Okay, so that's about this slide. So these are the questions from the past exam. So questions regarding cost of capital has come again and again. So you can find out like whatever we've discussed have all been derived from the previous year question papers. So D refers to December and 17 refers to 2017. So you can go through these questions, pause the video and just go through it. You should be able to thoroughly answer these questions. So again, these are the questions which have been asked in previous exams.